onto your local markets. The all-share index has declined by 0.7% to 87,238 index points. The rand is trading at 17.55 against the US dollar, 22.89 against the British pound, and 19.03 vis-a-vis the euro. So the currency has strengthened somewhat. A look at the commodities. Gold is trading at 2,708. I think that's the first time I'm saying $2,700 an ounce. Platinum is trading at $1,009 an ounce. Brent crude oil is trading at $74 per barrel on the dot. Well, James Turp is a fixed income portfolio manager at Sanlam Investments, and he joins us now. Thank you very much for joining us, James. So we're a few weeks away from the US elections. Do you expect much of the same in terms of the economic policies once it's done, regardless of who's going to take over? What are your expectations, and what would the possible impacts be on the markets?
Good afternoon, Nampu. Thanks for having me. And that's the question we're all trying to answer now, is just what will happen to our markets after the US election. We've had a look back at how we reacted to the last two US elections, Republican and Democratic victories, and ultimately our bonds and our currency just tends to move in line with global markets, it seems, after both of those. Now, the knee-jerk reaction is to think that a Republican victory might be a little bit less of a globalization-friendly result, whereas the Democrats would. But looking at the effects of the last two elections, it's more or less the same, really. So it's a difficult one actually to quantify. We know that the Republicans are talking about increased tariffs, which will lead to inflation, and we've heard that the Democrats' idea is to increase tax on the wealthy by way of just redistributing. And so we ultimately have to see how those policies play out. It's very difficult to judge. What we probably can be sure of is volatility going into and out of the elections, and then afterwards it'll calm down. It's not an easy one to forecast. So probably a good idea to be a little bit of conservatively positioned going into it.
So it's been a real roller coaster on the China and Hong Kong markets, with large gains one day and then large losses another. And now at the close of the week, we see them thumping. Do you think fundamentally the Chinese authorities have done enough in terms of stimulus measures to help turn that economy around?
It's a really good question. Again, there's mixed thoughts on it. It's been described as a sugar rush type stimulus where rates get cut, the market rebounds, and then it sort of retraces that move, and then you've had the fiscal measures introduced. What we've seen is economic growth in the figures, but still not to where it would be preferred, if you like. So it seems like the consensus is more stimulus is required to get China off the ground, as it were, or to increase its growth. So it doesn't feel like enough has really been done on that side.
So here at home, Reserve Bank Governor Lesetja Kganyago continues to speak about the reducing of the inflation target from the current 3 to 6% band. And he's talking about a lower target range, which he says would bode well for investor confidence. What's your take on that? What's wrong with the current, inflation target range, which we've struggled to actually reach just now?
So exactly, we've had a 3 to 6% range. As you say, for a long period of time, we sat around the 6% mark, so the upper bound of that range. You may recall when inflation targeting was brought in by the late, great Tito Mboweni, it was a band of 3 to 5%. So it was then broadened to 3.6. So that's worth just keeping in mind. But the ultimate thinking from Governor Kganyago is that by instilling low inflation and low inflation expectations, we ultimately will end up with lower interest rates, which will benefit the economy, because inflation affects the lowest income households the worst, as their basket of consumption is exposed more to the inflationary items such as imported fuel and food. So that's the thinking behind it, and I think it's a good idea. He did mention in his discussion this week at the University of Stellenbosch that it shouldn't be held hostage to administered prices, which we know are high in South Africa and ever increasing, such as the price of electricity. We've heard requests of in the 30% for increases. So notwithstanding that, and that's the one potential hurdle to getting this sort of lower inflation target, is that rampant administered prices. But nonetheless, he is quite right in saying if you can affect inflation expectations, you affect economic behavior, and thus getting lower interest rates will be beneficial to those most needing it in the economy. So it is a good cause. It's just not as easy to get there. And there's what they call a sacrifice ratio, because to get there, you need to keep interest rates somewhat higher. And by doing that, there's a cost to economic growth and demand in the economy. So it's quite a technical rabbit to pull out of the hat.
Yeah, one last one. You described him as great, the late Tito Mboweni. As a man who looks at economies, I just want you to give us your sense of the legacy that he leaves in terms of his commitment and contribution to the South African economy.
Well, I had the pleasure of having lunch a few times with the late Minister Mboweni, and an absolute pleasure and raconteur to be in the company of. As far as his contribution in his various ministerial positions, as well as governor of the Reserve Bank, he brought an approachable personality to the job. He made it more interesting. He was of the first to have the live news broadcast of the MPC statement, something during my earlier years in my career I looked forward to, his entertaining approach to monetary policy and making it really interesting, as I say, to watch. But he was ultimately a man of high integrity and always looking to do the best for South Africans, and just looking at his social media personality as well. He was just an all-round great South African, and will be sorely missed. That's my take on it, Nompu.
Indeed. Thank you so much for that, James. That was James Turp, Fixed Income Portfolio Manager at Sanlam Investments.